Michael Gomez, and I'm a real estate broker and an investor here in Nashville, Tennessee.
And I'm Seth Mosley, Grammy Award-winning songwriter and real estate investor.
We host a monthly meetup in Middle Tennessee for anyone who wants to build passive income, not only for retirement, but for today.
On the first Wednesday of every month, we bring in an expert from every area of investing to help you with things like finding deals, getting your financing locked in, asset protection, every kind of investing, so much more.
Our videos are all about delivering that content to you.
Go to musicandmoneyig.com for more info on our free monthly events. Hit subscribe on the page so you don't miss any awesome content, and hit that like button if you like it.
Don't let all the flair of my jacket distract you.
Here's the content.
Our beloved speaker today, which I'm going to leave for last, Chris Picciurro, is also my personal CPA, and I am telling you, he saved me so much money through the years that when I see him, I just want to kiss him. Anyways, I was talking about Chris. Chris is awesome because he understands real estate investment. And I always tell people, like, I'm a real estate broker and I deal mostly with investors. And I tell clients, hey, the same way you have divorce attorneys and you have immigration attorneys, it's the same thing in almost every profession that we do. You want to find somebody, if you're a real estate investment, you want to find a CPA that knows the ins and out, because they're going to speak your language, they're going to understand, and they're going to save you a ton of money. And Chris also offers audit protection. So if I ever get audited, guess what I have to do? Nothing. He will go to battle for me. So I love that. And I still think he charged me too little, but I'm not going to tell him that. No, when I met him, he said, I'm not cheap, but I will pay for myself. And I said, well, I like that. And he has every year. So if you haven't met this gentleman, well, today, you're going to be blown away. So please put it together for Chris Picciurro.
All right, thank you for that awesome introduction. Now I can't charge him anymore. Dang it. That's all right. That's all right. I'm going to set my little timer here because I tend to get excited about these topics. And I think you are too. That's why you're here. Or you were just here for the donuts, but I know your time is valuable. In all seriousness, let me click through this to get to our agenda. Thank you so much for coming today. I know it's the middle of the summer, and everyone watching on Facebook Live, I really appreciate it. And in all seriousness, I don't take these opportunities for granted. I've been very fortunate to have the opportunity to do presentations for NARPM and National Association of Realtors at all the way from every corner of this country, from Seattle to Hawaii, which they didn't have to, didn't have to beg that much on that one, all over Florida to the East Coast, Texas, even all through Canada and in Europe. And the point is it's so special to be able to do a presentation 3 miles from our house. We moved here about 3 years ago, and it was the only time my wife's agreed that I made a good decision. Maybe other than asking her to marry me. So 2 good decisions. But it's such an honor to present here, and we really have a passion for helping people out. We like to partner with our clients, and we like to help them implement healthy financial decisions. Agenda for today, we're going to do a little introduction. I don't think I could do better than Michael, so I'll just take it and run. We're going to do a portfolio case study. I've done another presentation for this group that I was pretty proud of, actually. But it was very technical in nature. It was about tax reform and the Section 199A deduction. And I thought, you know what? I think I want to start doing more things with real-life situations, real-life client situations. And I had a client that was purchasing 3 properties, and they had some questions for me. And I said, okay, well, let's just do what we do and run some projections for them and give them some feedback. So we're going to run through a real-life case study. These are some concepts that you can take home. I know your time is valuable, and I want you to walk away with 2 to 3 really good takeaways for you to implement in your own life, regardless if with your CPA or if you wanted us to take a look at things for you. And then we're going to hit you up with some tax planning considerations specifically for real estate investors. That is our niche. That's our ecosystem that we live in. Typically, I work with business owners and real estate investors, and what happens is a lot of real estate investors become business owners and vice versa, or people that are part of highly taxed households, because real estate is one of the few golden nuggets in our tax code that provides a great return at a low marginal tax rate. And then we'll open it up to questions. So any questions that you have, I'm happy to answer. I do understand taxes are pretty personal in nature. If you have questions that are more personal in nature, please just leave your card. I'm happy to answer them. We really like to be a resource for this group. And honestly, when I came to this group, I came as a potential or a real estate investor. Mr. Tom Lonnie, thank goodness, introduced me to the group. And I just came just to sit down and learn from other people. So And I've learned a lot, so it's pretty cool. So if you have questions, I'm happy to answer them. I'll introduce, I've got a couple people from my team here. Peter Crane is back there if you are live in the audience, and Robert McWilliams. If you have questions, you can ask any one of those or give any of us your card and we'll follow up with you. That's me when I didn't have a beard. So my wife is here. She likes the beard. I'm kind of, it's a lot of maintenance. I like being bald, but it's the only trump card I have with her right now. So I'm going to keep it. I'm going to roll with it. But this is just some of my background. Again, have been very fortunate to do presentations for real estate investors all over the place. So again, we're going to run through a case study. And whenever you have a case study with real estate, we have to come up with some assumptions. The first assumption we're going to make is that we are in the 25% marginal tax bracket. That number is going to be different for every client we meet with. And I just said yesterday at another presentation, when people come to us and say, what is my tax bracket? That is like a real estate agent having a client come to them and saying, my house is worth this on Zillow. You just want to put your head through a wall, because your tax bracket is not the most important thing. The most important thing is, what is your marginal tax rate? For instance, someone might say, well, capital gain rate's only 20%, right? True, but the depreciation recapture is 25%. Net investment tax, or NIT, is another 3.8%. Plus, you might have state or franchise tax considerations. So the point is everyone has a different marginal tax bracket. And hopefully you kind of know what that is. If you don't know what that is, you need to figure it out or work with someone to figure it out. But with this case study, just because people could be from all over this place and different entities, we're going to say it's 25% is your marginal tax bracket. The financial forecasts in this projection are based on the assumptions that we're going to show you for each property, which would mean what the anticipated rent amount is, what the anticipated purchase price is. We do make allocations for vacancy, and these are real numbers that we gleaned from a portfolio. We're going to assume the property is owned for the entire year. That makes life easier when we're determining mortgage interest deduction, depreciation deduction. Obviously, if you buy a property in the middle of the year, because not everyone, if you're like me, you're probably trying to watch football all day on January 1st. So usually you don't own the property all year round, but we're just making the assumption that you owned it all year for calculation purposes. It just makes life easier. We're also going to assume all the losses from a property are deductible. And that may be a large assumption, and that's something that we're going to talk about a little later on how do we make losses deductible, and how do we avoid what are called passive activity loss carry forwards. So for some people, they may have a loss on a rental property, and it kind of gets trapped until either their income comes down or they have a gain that can offset that loss. But for this purpose, since we're dealing with real estate investors, I'm going to go into the assumption that the losses are deductible. And if they're not deductible, we're going to meet and we're going to try to figure out how we can make them deductible. And what I mean by that is you might have other gains, you may have other tax attributes that we can create gains to offset some of those losses. The third or the last assumption is that if we perform a cost segregation study, that you will receive a 25% immediate tax deduction. Now with tax reform, it made the cost segregation studies a little, I should say, a little more attractive for investors, especially if you have single family homes that are even under $200,000. With tax reform, any because we could talk about cost segregations for 2 hours if we really wanted to, but any portion of that home purchase price that you can allocate to personal property, meaning the lighting, the electrical, the flooring, the windows, all of that under tax reform is immediately deductible using bonus depreciation. So if we're just going to make the assumption that 25% of that home acquisition price represents personal property. If you're buying a fix and flip, or a fix and hold, I should say, if you're flipping it, then the depreciation recapture doesn't matter. But let's say you're fixing it and then you're putting it on the market and renting it, that number could be a lot higher under cost segregation. But again, let's just assume 25%. All right, I'll go back to there. If you have a question or if you're kind of stuck, just wave your hand up there and I'll stop, and I know we have time for questions at the end. So I'm going to introduce to you briefly because list radio is not very fun, and someone standing up here and reading the screen is not very fun. But so the 3 properties that we're going to talk about. This is property 1, not a bad property for $107,000, probably not here in Franklin at least. But this acquisition price is $107,500. Target rent is, you're going to see that over on the left, is $1,025. And again, we have allocations for vacancy. We're assuming if you finance this property that you're putting 20% down and you have a 5.6% interest rate. Again, these are spreadsheets that we use on a daily basis in our practice, so we can plug and play with clients saying, well, what's my interest rate? What, and those variables can change. But we have to come up with some type of assumption. So with this property, this is what we're just going to call home number 1, because we have stripped the addresses to protect the innocent here. Home number 2, quite a nice pad. I don't know if it comes with are those? What? Tombstone. Okay, well, some people like to live next to graveyards. I guess maybe that's why it's only $89,000. But for this one, again, it's hitting the 1% rule barely, if you know what that is, and most of you do. $895 of rent, and assuming we take a mortgage out, the mortgage would be $71,600. So this is house number 2. And then our final house reminds me of playing Monopoly. House number 3, $122,500 with the rent of $1,150. So these are the 3 houses that this case study has purchased, or this sample client has purchased. So again, client comes to us with these 3 properties. They're thinking about purchasing the properties. They don't know how to do it other than like just signing your name on DocuSign. But in other words, how are they going to finance it? Are they going to finance it using cash, using a mortgage? And these are the real things we have to think about, because every person is different. Some people are looking for more cash-on-cash returns. Some people are more comfortable with leverage. Some people are anti-debt. So you really have to get under the hood of your client and determine what's going to make them feel better at night, but also give them the numbers. So if we look at these properties and say, okay, option 1, without a mortgage, what does this look like? And guess what? I think I'm blocking something here. Oh, the speaker is, okay. Well, that's all right. I could tell you this number right here is 11.28. So what are the things that we know our clients are worried about? Net cash outlay, net cash flow, and first year cash return, right? You want to get your cash back as soon as possible. So assuming you have a mortgage, we said 5.6%, 20% down, what we're looking at is, even though you're generating a positive cash flow of $7,200, look at your taxable income, $600. So do you think this administration likes you to invest in real estate? I think so. That's huge. So you're looking at, although you have again net cash flow of $7,208, we've already deducted your principal payments of the mortgage and any income tax exposure. You're all in. Cash outlay is only $63,900 because you financed 80% of each acquisition price. So even I think our rising 5th grader could do the math on this one. Net cash flow into cash outlay, your first year cash return, and I know this number's blocked, is 11.28%. So that's a pretty good net cash first year. Again, you're going to want to work with someone that really understands lending, like Billy, because there are some restrictions as far as expanding your portfolio with traditional loans. And again, that's another episode. But that's why this stuff's a team sport, and we're going to make sure that we're part of that team. So yeah, it's a pretty interesting fact pattern. Not many places where your net cash flow could be over 11 times your taxable income. So that's the power of the depreciation deduction. So for any new listeners to the program, the depreciation deduction is really a cost recovery. So any money that you put into the property, you get to recover that money typically over a 27.5-year period, straight line. But we'll talk about some tax strategies to accelerate that. So that's with the mortgage. We're going to look at another case number 2. Case number 2 says, okay, well, I'm kind of anti-debt. I have cash. I want to keep my wife out of Target. Not me, maybe. And you don't want to finance it. So again, every client's a little different. Same numbers on the top except for the mortgage interest. And then obviously the principal payments are gone there. The income tax is different. So your first year net cash outlay is going to be $319,500. That's a pretty significant cash outlay. Your net cash flow is $21,259. And then your taxable income is $14,843. So still pretty good. Your positive cash flow of $21,000, you're only paying tax on $14,843. And you might not even pay tax on that entire amount. You might qualify for the Section 199A deduction, which I know you're just waiting to talk about that, and we're going to save it for the end. So you might pay tax on it even less. Your first year return, I know that's a little blocked, 6.68% down here. So obviously, your first year cash return is half. Isn't that weird? That you're using cash, but your first year cash return is half of instead of using financing. The answer is whatever the client's most comfortable with, right? So it's not necessary. I'm not advocating, hey, just get a mortgage on all these properties and leverage or use your cash. Our job is to be a scoreboard, talk through the situation with potential clients, and let the numbers run for them. So let's assume we have a client that's in case number 2, and they kind of want the drink the milk without buying the cow, so they don't necessarily want the mortgage. What can we do to help them get their cash back into the system so they can continue building their war chest of properties? That's where we might suggest they have a cost segregation study done. So real briefly, cost segregation study, like I said, you're taking the personal property portion of an asset and you're immediately deducting it. We made the assumption that 25% would be immediately deductible. If you have a property that you've owned for 5 years and you're sitting there thinking, oh man, I should have done that cost segregation thing. It's okay. You can actually do the cost segregation study today and take all the depreciation you should have taken from 5 years ago in one lump sum. It's called the 481A adjustment. Why would we do that? If I have a client that is selling a commercial building, let's say it's on a lease option to own, and I know in 2021 they're going to have a big capital gain. What am I going to do with their other property? I'm going to hold off on the cost seg study, and I'm going to drop it on 2021, so now we can offset a lot of that capital gain. So these are things, again, we're thinking about, do we accelerate deductions? Do we accelerate income? Do we decelerate deductions? Do we hold off on them? But let's assume this client says, hey, I want as much cash back as I possibly can. What we're going to say is, okay, this is a buy and hold property. Assume a buy and hold property. Let's do cost segregation study on a couple of these homes. So from case 2 to case 3, the big difference you're going to see is this depreciation deduction. $10,000 on case 2, boom, goes to $53,000. And I did cost seg study on just 2 houses instead of instead of the 3, because what I was trying to do is get the loss close to $25,000. I'm assuming this person can deduct the loss, but maybe they're not a rental real estate professional. Maybe they have what's called active participation, and they can take the $25,000. But let's assume you do 2 cost segregation studies. We're going to assume they cost about $1,000 each. You see your taxable income goes down to $28,710 from case 2. Still, cash outlay still $319,500. I'm going to go back. Hopefully you've had your Starbucks this morning. $319,500 is the same amount. What happens to net cash flow in case 3? $32,158 is your positive net cash flow. It was, with no mortgage, $21,000. So you just increased your net cash flow by $11,000 year 1. Your first year cash return, I know it's like what's behind door number 2? It's actually 10.06%. First year cash returns 10%. So you're getting close to having that same first year cash return if you had a mortgage by doing the cost segregation study. Now you can do both, but the point is I'm trying to show you some of the real life strategies that we're going to use with clients. Yes? Okay, the question is, what's the continued impact of taking the cost segregation study? Great question. So the question is this sounds great right now, but I'm also taking an extra $50,000 approximately of depreciation in year 1 that I'm not going to receive in the future. So what you're doing is you're taking deductions that you would have to take over a 27.5-year period, and you're getting them year 1. So when does this make sense? If it's a buy and hold property, if it's a property that if you sold, you might do a 1031 exchange out of, or if a client is maybe more mature aged, and if we look at the mortality tables, because I'm not a predictor, 27.5 years seems a lot farther in the future. And again, I really believe we are in the lowest tax rate environment today than we will be in the rest of my lifetime. But if I feel someone's marginal, if someone is 45 years old, does a deduction today and cash in their pocket today plus the time value of that money, does that make sense now versus is 60 years old when they may not be in such a high income bracket? So that's what we have to consider, but that is an awesome question. Cost segregation study, you're not getting any additional deductions. You're accelerating a deduction. But sometimes the time value of money and the marginal tax rate you're in today is a lot more than in the future. Okay, great question. So what happens if we have to recapture? When you sell a property that you have taken depreciation, or you should have, that's another thing. I see client tax returns that are self-prepared sometimes and said, well, I didn't take depreciation because I don't want to recapture it. Oh gosh, that's even worse. Because you have to add back that depreciation if you took it or didn't take it with the IRS. So at that point, I won't get into a real case that just happened yesterday, or last week, that we found $200,000 of untaken amortization from 13 years back. So we have to we're going to recapture it, and we have to apply for the IRS for a change of accounting method. But that's another episode. But with this episode, the recapture is paid back at a flat 25% rate right now. Now, here's the situation though. There are a lot of things with real estate that are advantages. There is something, so if it's a buy and hold property and you pass away, your beneficiaries inherit the property, guess what? Get out of jail free card, right? All that depreciation goes away and they get a step up in cost basis to fair market value and get to redepreciate the whole thing. So that's why you might hear CPAs, maybe they're down having a scotch at Oh Joyful talking. You don't really want to talk to these people. But if you overhear them saying, it's much better to inherit something than sell it or gift it. So again, it comes down to the client. Or I might have a client that has a sale and has a huge gain that year and has a property they probably going to keep, and we might do a cost segregation. Another situation might be have a client that blew their 1031 exchange and has a huge gain and then went and bought another property because they thought that they can reinvent the rules about 1031 exchanges, then you might slap a cost segregation study on that property. So essentially, you're accelerating those deductions. So, but yeah, it's an acceleration of a deduction, which might make sense, it might not. The goal and the thing is, though, if you have a client that's looking for income, let's say they're mature aged, they're probably never going to live out that depreciation. You might as well take as much as you can now, because their beneficiaries are going to get a step up. Especially in certain states where you have a living trust and let's say you have a married person where their spouse, and many times, I know in Tennessee, they can get a double step up in basis if it's jointly titled. So there are a lot of estate planning considerations we have to throw out there, but that's a really good question. So just think this cost seg is, you're accelerating the deduction. Oh, Bill loves to put me on the spot. That's a great question. I will have to check on that. I do not think the recapture can go into Opportunity Zone Fund. I think just the capital gain can go into it because it's classified as a separate type of gain. But it can go into 1031 exchange. Really good question.
Can you do the bonus depreciation on properties you had before the kick?
Great question. Can you do the bonus depreciation on previously owned properties? No, it's 2018. Placed into service 2018 under the tax reform or in the future. But if you have a property that you've owned for like 7 years and you think a segregation study might make sense, if you segregate and you have lighting or windows that are a 7-year asset and you've owned it for 7 years, you'll be able to pick up, just like you got the bonus depreciation, you'll be able to pick up all that depreciation immediately. So you're kind of circumventing that. So really good question. Thank you very much. So those are the 3 case studies. It spawned a lot of good conversation. I'm going to just check my time because I just get, I love this stuff. Oh, good. We're going to have time for more questions, and we're going to have time for the best part, some tax planning considerations. But you can see how different decisions change things. Now, tax planning and advising does not occur after January 1st for the last year, right? These things have to be planned for typically in advance. Now, there are some things that I want to share with you that can be done. So for instance, let's say you have a tax extension right now and you have not filed your 2018 return yet. You can still do a cost segregation study up until you file your return. So, tax extensions are not a 4-letter word. They do provide you with more time to make a lot of decisions, such as maybe funding retirement, doing cost segregation studies, potentially, depending on the year, doing the opportunity zone, and completing 1031 exchanges. So a lot of this comes down to planning and just communicate, build your team out. We had, was it David Green talk about building a team out a few months ago, and this is a team sport. Yes? Correct. Thanks, Bill. So if I did a cost segregation study today, I could use it for 2019 moving forward, assuming even if I purchased the property in 18. That is correct. And before you just do one, what happened, the real fact pattern is someone's reviewing your tax return with you. I say, you know what? You might want to consider a cost segregation study on this. We contact a couple companies that do it. They look at the property and they send us a cost benefit. And you're going to know the results in worst case scenario before you commit to it. The other one more thing is even if you do a cost segregation study and you decide not to use it, it doesn't commit you to setting your depreciation schedules. You set your depreciation schedules when you file your tax return. I've never had anyone do a cost seg study and not use it, but it could happen. All right, tax planning tips. Probably God's gift to the American taxpayer, the business owner. Under tax reform, non-business owner tax returns really got simplified. Our standard deduction went to $24,000. So Joe and Joni, white picket fence, they have a simpler tax return. A lot of them really don't need. I just met with someone 2 days ago and said, I'm putting out a fire for you, but you really don't need me moving forward. You have a couple W-2s, just go do your tax return. There's not much so The flip side of that is any business owners, real estate investors, your stuff just got super complicated, but it's a good thing. The Section 199A deduction, which I know we spoke about last year a little bit, and we had an amazing, Tom was with me and Jody. We had a roundtable discussion about tax planning last November, but the 199A deduction, what that is that's an additional federal deduction that could provide you with up to a 20% tax deduction based on your net income or taxable income. Now there are qualifications and there's some planning involved, and that's another episode. We're not going to get into all the details today, but making sure we get you qualified for the Section 199A deduction is essential, and there's definitely strategies that we can use using even people in this room to help you out with. As it pertains to rental properties, for my case study that had a profit, my no mortgage case study, there was a question thrown out there when the 199A deduction came out that said, okay, well, if you have rental income, do you qualify for the 199A deduction? That's an extra 20% federal deduction. And what do you think the answer is? Like the answer to every darn tax question. It depends. People didn't know because does owning rental property count as having a business? Well, the IRS said this is a mess. So in January 2019, they came out with some guidance that said, okay, we're going to give you guys a safe harbor election that you can make, that if you have rental income and you commit at least 250 hours per year to that activity in general, that you're going to qualify for the 199A deduction. So a lot of our clients that had rental income that I know put at least 250 hours a year into this activity, we took the safe harbor Section 199A deduction. The cool thing about the 250 hours is that it's not just your time, it's your time plus any subcontractors that you hire. So if you have a professional property manager, those hours count for the 250. So if you own rental property and you have a profit, then take a look and see if you received that 199A deduction. And if you didn't, you need to think about it for the next year, because a safe harbor is an election. In common terms, I guess, non-IRS terms, what the safe harbor means is it's like being in Monopoly, being at jail, but just visiting. You don't have to pay anything. You're not going to, and they're like, okay, you qualify, just based on that, we take your word for it, it's self-certification, we're not going to, you move forward. Now, if you get audited, you would have to prove the 250 hours, but that's not that many hours to prove, including all the subcontractors that you hire, like property managers and maintenance. We talked about this a little bit. You want to try to avoid the passive activity losses. So if you have a W-2 job and you own the rental portfolio and you create a $40,000 loss, you might not be able to take that entire loss because it's considered a passive activity. So there are things that we have to do to allow you to take that loss, such as have passive gains, or take a look at maybe you have a spouse that puts a lot of time into the rental properties, and maybe that spouse might qualify as active and material participation, or has a qualifying amount of hours to be able to deduct those losses. To be a qualified real estate investor and not really have to deal with the passive activity loss limitations, it's kind of difficult. It's gonna have to be at least 750 hours a year into the activity, which isn't that much time. But the other doozy is it has to be more. It has to be your primary activity. So if you have a W-2 job that you work 2,000 hours, let's say you're a doctor, or well, let's pick on. No, I wouldn't want to pick on lawyers because my friend's here. Who can we pick on? Accountants. So let's say you're an accountant, you work 2,000 hours a year doing your geeky tax stuff, but you happen to put 1,000 hours into your rental properties, and that's why your wife likes you, because you're never home. Well, even though I qualify for the 750, it's not more than half of my activity, so I would not be a qualified real estate investor, and I wouldn't be exempt from passive activity losses. I do want to point one more piece of guidance out. For those of you with short-term rental properties, if you have a short-term rental property and you are providing most of the management services, please talk to your CPA. There might be a way for you to move that activity from what's called Schedule E, where rental properties go, to Schedule C. Why would usually want to avoid Schedule C? Because you have to pay self-employment tax. But if you're self-employed and paying self-employment tax on another activity, and you have short-term rentals that you can put on Schedule C, then you can offset that self-employment tax. And maybe you throw a cost segregation study on your rental property, and maybe you get huge deductions. So it's just something to consider. Work with your tax professional to understanding the passive activity loss limitations and trying to avoid them. Oh, I kind of jumped the shark on that one. So I already talked about the income thresholds and material participation. I talked about the de minimis safe harbor election as it pertains to the 199A, or rather the safe harbor election as it pertains to 199A. There's another safe harbor election you need to be aware of for rental property owners and business owners. The IRS came out and said, we don't want to screw around with all your silly repairs and maintenance receipts. So you can make an election on your tax return to say anything under $2,500, I'm just deducting. So that washer you bought for $800, you get to deduct it all. Anything under $2,500 line item, you get to deduct. In general, there's always exceptions. So if you repair a window or a few windows, if you do the windows for the whole house, you'd probably have to capitalize it, although you would get the bonus depreciation anyway. But that's an election you want to look at your tax return and make sure you're making, that safe harbor election to take anything under $2,500, no questions asked. It plays a role in a lot of ways. Let me just hit on a couple here in Tennessee. If you own your properties in an LLC, the bonus depreciation is added back to your income, and you could pay an extra 6.5% tax. If you just make the safe harbor, you get to deduct it immediately. The only time when you might want to avoid this safe harbor election is if you are really concerned about bankability, and because the lender is going to look at your tax return and they're not going to add, in general, not going to add back your repairs and maintenance. So you might want to capitalize things, just take the bonus depreciation because you know the lender is probably going to add it back. So these are planning things you have to think about, but you don't have to capitalize, again, even if it's a fixed asset. If you do a whole new carpeting and it's $2,300, you could just make an election to deduct the whole thing. Rental grouping election. If you have multiple rental properties, look at your I know if you get insomnia and it's light out till 9 at night, look at your tax return. Go through it with your tax professional. Make sure that you're making a rental grouping election. What that means is when we talked about these passive activities, if you have 4 rental properties and you want to prove that you have active participation in them and you're really treating it like a business and you want to deduct your losses, you would have to prove that active participation with every property. So what you can do is you can make a rental grouping election and group all your rental property activities into one activity. That way you only have to prove that you have active or material participation or with your whole portfolio. Same with your de minimis safe harbor or the 250 hours. So you have to make this election to group your rental properties. This is probably going to be on like page 112 of your tax return that no one looks at. But just make sure you're making this grouping election. We have a lot of clients that might take out a home equity line of credit on their primary residence and use that to buy other rental properties. That's okay. But you're going to want to make sure you make what's called a 10T election. What a 10T election is you're electing to take mortgage interest derived from a primary residence and deduct it against your rental properties. Because we'd much rather have that deduction on Schedule E, which is the rental property schedule, than Schedule A, which is your personal deduction. And that's okay. It's not illegal to do this. Just communicate with your tax preparer so we can make that election and give you a better deduction for it. Especially with tax reform, I have a lot of clients that aren't even itemizing anymore. Yes? Okay, so do you use the home equity line to buy land? No, to lend money, hard money lending. Okay, so if you are, so the 10T election, the question is what if you take home equity line of credit and interest and lend it to someone and you're the mortgage, you're the bank, then that deduction could be investment interest deduction that would offset up to your rent, the income. So if you got $5,000 of rent income from that land contract and you had $4,000 of interest, you'd be able to deduct the $4,000 of interest. You would not have to do it there. You would put it, I would just put it on what's called a 4952 as interest deduction. State tax considerations. I know we live in a wonderful state that does not have a state income tax, but if you buy property in states that do not have a state income tax, you still have to file in those states. Now, typically with rental properties, you're not going to have much tax exposure, but it's something to consider, especially our clients that buy in Memphis. They might have some properties in Mississippi, in the Gulf Coast. You're going to have Alabama. So it's just something to consider. And if you buy properties in an LLC, here in Tennessee, you're going to want to consider that bonus depreciation does get added back to your income, or you want to make what's called a FONT election potentially, which stands for family-owned non-corporate entity. I know it's getting really exciting in here when we're talking about fonts, but if you own property in the state of Tennessee and you and your family is the only owner of the LLC and all it owns is a rental property, talk to a tax professional. You should not be exposed to franchise tax. You should file what's called the fonts exemption. I guess it's grass cutting day. That's good. They got to keep it nice here. And I kind of alluded to that entity selection. There's no one entity is best. Really consider, you've got to weigh. I know LLCs are popular, but you've got to weigh the liability protection with understanding that you might be violating your mortgage by putting property in an LLC. There could be a due on sale clause. Before you do things, work with your lender, work with your attorney, work with your CPA, work with your team that you've assembled or start assembling now to make sure you're doing this in the best way possible. Bless you. And I already talked about cost segregations as another tip, but great tool to use. There are other things. I mean, we touched, you might have heard about land conservation easements. We talked about qualified opportunity zones. That's a really good tool if you have capital gains that are not even real estate related that you want to invest into some type of investment to defer the capital gain. 1031 exchanges, I know we've talked about before, but I was trying to keep these tax tips specifically for this case study. We had a lot of awesome questions. If anyone has any other questions, I'm happy to talk through them. And they do such a great job here, but if you want a copy of all these slides, just see myself or one of our team members and give us a card and we'll just send them to you. There's no sign up or newsletters or anything. Yes, ma'am. Great question. Is the rental grouping election only pertain to the 199A deduction? No, the rental grouping election, you're going to want to group those rentals when you're testing for active material participation. Because what could happen is, let's say you have a property that has a profit and you have 3 that have a loss. You want to be able to deduct those losses. Now, they'll offset each other without the grouping election, but what the grouping election is doing is it's allowing you to aggregate all the time with that entire portfolio into one activity when the testing comes in for active or material participation. Yes?
Of the case study you did, how much would it vary if you had 3 short-term rentals versus 3 long-term rentals?
Great question. So on the case study, I'm going to go back. How much would it vary if you had a short-term rental versus the long holds? Well, I guess with a short-term rental, typically you're going to have more return on investment immediately. There's going to be usually more cash. On the short-term rental, if you're self-managing it, and the average stay is 7 days or less, you could potentially put it on Schedule C, and that would advocate for maybe the cost segregation study. Typically, the short-term rental is going to be a condominium, usually, which is going to lend itself to the cost segregation because there will be more furnishings. There's going to be less allocated to land because land is not depreciable. So it might make a bigger case for cost segregation, although it depends if you intend to buy and hold it. Correct. So Bill asked, the key with cost segregation with short-term, I would say that if you have a short-term rental, the key is to make sure you could deduct the losses and do the cost seg. So for some people, it could stay if they're not self-managing it, but they're going to qualify as a real estate professional, you can leave it on Schedule E and still take that huge deduction. Yes. So the key is make sure we could deduct it all. If you move it, if you can get it on Schedule C, then it's going to be more deductible. Yes.
Thank you. Let's say you've owned a property 12 years already, rental property, and it's owned by two other parties. So you're a third owner. Can one party do cost segregation and the other two do normal accounting on the depreciation? And would you even do cost segregation on a property you'd owned 12 years already?
Great question. Is the partnership, is it owned by a partnership entity?
Individuals.
That's a great question. I would imagine you could segregate your third of the cost if it's titled 1/3, 1/3, 1/3, because it's not owned by an entity. The question you'd have to think about is if you've already owned it for 12 years and it's a 27.5-year life, does that make sense in his acquisition price and you're already chopping it into a third? So the practical answer might be it might not make sense, but I believe you could do a cost segregation study on a third of it because that's your personal basis. If it's a commercial property, those depreciation lives are 39.5 years, so it would make a better case for the cost segregation. What concerns me is that if you're a minority owner and two of the three parties decide to sell the property, you're kind of stuck unless you take your third and roll it into a 1031 exchange.
Understood. Second question.
Yes.
Primary residence that's either on the market or considered for rent, are you allowed to write off that mortgage interest still?
Great question. So there was a lot of banter when tax reform came out about the primary residence income exclusion or 121A exclusion. That's a code section that it pertains to. As it is now, as long as a property was your primary residence for 2 of the last 5 years, like if you were in the House of Representatives, no coincidence there, but that's all right. So if it was your primary residence for 2 of the last 5 years and you sell it at a gain, you can exclude $250,000 as a single person, $500,000 of gain as a married person. The mortgage interest on that is still deductible. It depends on if it's a legacy mortgage, it's up to $1 million of acquisition cost. New mortgages are now $750,000 of acquisition cost. So if you itemize your deductions. Now think about this though. If you own a property, you bought it for let's say 300 grand. It's now worth 500. It was your primary residence. If you sell it, you're going to walk away with $200,000 of tax-free money. If you start renting it out, you have to start depreciating it at the lower of cost or fair market value. So you have to start depreciating it at the $300,000 level you owned it at, and then you're going to start slowly throwing away that 121A. So you're probably better off selling it and maybe buying something else, or, you know.
It's currently vacant, and it's up for consideration for both, and getting through this winter, the fall and winter season that's coming up, and then maybe doing some renovation on it to increase my capital gain on it.
Correct. So that would be a tax-free capital gain as long as it hasn't been rented out before. You have a 3-year period to do that.
Okay.
So, and I'm not saying don't rent it out, but you have to look at the opportunity cost of those funds. You hate to throw away a big 121 exclusion. Those aren't recyclable. There's not an extra bin. You can't get it back.
Hey,
Yes,
Chris.
Joel.
If a couple owns a bunch of properties, what's the strategy from a inheritance standpoint to title those? I mean, jointly, you split them up individually. You talked about this double step-up basis for jointly owned property.
Yes, so I would first consult one of our attorney friends, but typically in the state of Tennessee, if you own it jointly in a trust, then you're going to get a double step up in basis when the first spouse passes away. That's my understanding. So that's pretty darn good. In most community property states, you will get a double step up in basis. So I would say either own it jointly, or if one of the spouses is more mature in age or less healthy, in general, you'd put it in that spouse's name. Especially with the estate tax exemption right now being over $11 million. Now, if that changes, there's been a lot of talk about that as the federal fiscal year ends September 30th, and they need to balance the budget, and they're talking about maybe compromising and reducing the estate tax exemption. But in today's environment, at $11 million per spouse, it's probably okay to overload assets into one of the spouse's name. Well, thank you very much. I think all the lights starting to get to me. I'm glistening.
We got one more, and then we're going to call it. Here we go.
The double step up that you're referring to, are you talking about the 50-50 step up? 50% on the first spouse, 50% on the second spouse for jointly held?
What I'm saying is if you own a rental property, let's assume I have a business partner and we own a rental property together. And it's titled, now I don't know if I want to say, but let's say I own it with a spouse. If the spouse predeceases me, I get to automatically step up 50% of the basis. And it's my understanding that if it's in a living trust in the state of Tennessee, that there'd be a double step up in basis. So I will have to verify that with the estate planning attorney I talked to.
I have one right here next to me. No.
Oh, good.
Anything to add, John?
Well, typically you're going to own it tenants by the entirety in Tennessee, so a spouse will automatically own 100% of the property at the death of the first. So there's really not any need for the stepped-up basis because they have it from the beginning. And if they bought it together before the marriage, then one of them quick claims it back to the two of them.
But and sometimes we see a lot on rental properties where you might have a widow and they never stepped up the basis for tax purposes and they have a lot of missed deductions. So that's something to look at. Now that we killed half everybody off, but thank you very much. I appreciate it.
Put it together for Chris. Chris, thank you so much.
My pleasure.
Wow.
Hey, thanks for learning with us today on the show.
We would love to meet you at one of our free monthly meetups in Middle Tennessee.
Hit the thumbs up button if you like the content. Make sure you hit subscribe so you don't miss a thing on this channel.
Check out another awesome investing video here.